Welcome back to the channel. Today we're diving deep into one of the most reliable wealth building strategies of all time, dividend investing. If you've ever wondered why investors love dividend-paying stocks and ETFs, or how dividends can actually help you retire earlier and more comfortably, this video is for you. Over the next 80 minutes, I'll take you step by step through the philosophy, the math, and the psychology behind dividend investing. By the end, you'll know exactly why dividend investing is a winning strategy, and how you can use it to secure your financial future. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Dividends represent a tangible connection between shareholders and a company's success, serving as a share of the profits earned. Dividend investing emphasizes a strategy focused not solely on stock price growth, but rather on choosing stocks that provide reliable income through consistent dividend payments. Historically, companies like Coca-Cola and Johnson & Johnson exemplify the strength this investment strategy can yield over time. Understanding dividend yields further clarifies the potential return on investment one can expect from these equity holdings. In conclusion, embracing dividend investing allows individuals to benefit from both capital appreciation and consistent income, highlighting the importance of stability and reliability in the stock market. By recognizing the significant role dividends play, investors can make informed choices that align with long-term financial goals. Dividends represent a reliable source of income for investors, even in uncertain market conditions. Unlike relying solely on fluctuating stock prices, these regular cash payments bring a sense of security. Historically, within the S&P 500, dividends have played a crucial role in delivering substantial returns, showcasing their importance in a solid investment strategy. Dividends contribute approximately 40% of the total returns in the S&P 500, highlighting their significance. Consistent dividend payments not only reflect the financial health of companies but also provide investors with a stable cash flow, making them an essential component of a well-rounded investment approach. Emphasizing dividends reaffirms the value of choosing disciplined, financially sound firms. Dividends provide more than just cold hard cash. They offer a psychological safety net that enables investors to withstand turbulent markets without feeling the weight of uncertainty. This reassurance is vital, as it fosters a sense of ownership and encourages long-term strategies. Whether reinvesting or spending, dividends enhance an investor's journey. The blend of psychological comfort and financial returns transforms dividends into a powerful motivator for investors, reinforcing their confidence while navigating the ups and downs of the market. Ultimately, the experience of getting paid to own nurtures a deeper connection to their investments. Imagine that with each dividend payment, you're not just receiving cash, you're feeding your investment tree. Just as those seeds grow into new trees, your initial investment grows exponentially, creating a forest of wealth over time. In this way, the annual dividends act like those seeds, reinvesting to produce even more dividends, compounding your earnings. Each cycle strengthens your financial future, illustrating the power of consistent reinvestment. By embracing DRIP, you transform a single investment into a thriving estate of assets. Just as the tree multiplies through its seeds, your financial potential expands when dividends are reinvested, ultimately leading to greater wealth and security for the future. Investors often face challenging decisions in building their portfolios. Some might be tempted by the high yields of energy and right stocks, lured by the promise of immediate returns. However, others may opt for the stability offered by dividend growth stocks, valuing long-term reliability over short-term gains. Combining these strategies can pave the way for a balanced investment approach. High-yield stocks attract those seeking immediate income, yet they carry notable risks, especially in volatile markets. Ultimately, a well-constructed portfolio aims for harmony between growth and yield, ensuring sustainable income that adapts to market fluctuations. Balancing high yield with dividend growth provides opportunities for security and potential wealth as individual financial goals evolve over time. Finding this equilibrium is the key to successful investing. Understanding these key metrics is crucial when evaluating investments. First, the payout ratio indicates how much earnings are paid out as dividends, revealing risk levels. A lower ratio often suggests safer investment potential, while a higher one may signal red flags. Next, consider the dividend history of a company, particularly those classified as dividend aristocrats or kings, which have consistently raised their dividends over time. In conclusion, by analyzing these metrics, payout ratios, dividend history, earnings growth, and balance sheet health, investors can make informed decisions and avoid pitfalls like unsustainable yields and excessive debt, ensuring a more secure investment strategy. Exchange-traded funds, or ETFs, like SCHD, VYM, and HDV, offer dividend investors a unique opportunity by combining the benefits of diversification and simplicity, all while maintaining low fees that enhance overall returns. When comparing ETFs to building an individual dividend portfolio, the advantages become evident. By choosing ETFs, investors can easily access a diverse set of companies, reducing the risks associated with individual stock ownership and creating a more stable income stream from dividends, making them an attractive option for both new and seasoned investors. Investors often fall into the trap of chasing unsustainable high yields, overlooking the importance of strategic decision-making in their portfolios. They might also ignore tax implications, which can erode returns. In the world of investing, neglecting to reinvest dividends can hinder long-term growth. Furthermore, failing to diversify across sectors exposes portfolios to unnecessary risks. Ultimately, emotional selling during market downturns, despite strong dividends, may lead to missed opportunities for recovery and growth. To create a robust investment strategy, begin by focusing on ETFs such as SCHD and VYM, which provide a solid foundation for building wealth. Gradually introduce high-quality dividend stocks to enhance your portfolio further while ensuring automatic reinvestment of dividends for optimal growth. Diversification plays a crucial role in your investment success, combining a mix of growth, stability, and yield to mitigate risks. This simple starter portfolio effectively balances these elements, with 40% allocated to SCHD, 30% to VYM, 20% in dividend aristocrats like J&J, PEP, and Co., and 10% in REITs to secure a reliable income stream. By following this strategy, you'll pave the way to financial prosperity. Dividend investing is more than just collecting checks. It's about building a reliable, growing stream of income that can support you for life. While markets go up and down, dividends provide consistency, peace of mind, and long-term growth. If you're serious about financial independence, dividend investing is a winning strategy, and it always has been. Thank you so much for watching. If you found this valuable, make sure to hit that like button, subscribe for more investing content, and drop a comment below sharing your favorite dividend stock or ETF. Until next time, happy investing.